Hey everybody, happy Thursday, June 11th. It's about 10:45 in the morning on the West Coast, and it's time for another market update. Well, deja vu. I feel like I have begun every market update over the last couple months, 3 months now, I believe, talking about this. But the war with Iran continues. As we've talked about, the news changes from day to day, and the markets change along with it. Whether it's bad news about hostilities or if it's about peace deal and good news. But the news over the last couple of days has been bad news because it sounds like we have begun strikes again on Iran on their infrastructure. I think they've done some retaliation, so it doesn't seem very good on the peace front. What's happening? Um, the markets again aren't, the stock market's not reacting negatively because the stock market's very, very optimistic always, and they got others. They're looking at chip sales and all that kind of stuff. But oil prices obviously go up when this kind of stuff happens, which is a worry when it comes to inflation, which we'll get to a little bit later. But really the bubble is kind of waiting to burst, I guess, when we truly do get some sort of peace deal in place. That obviously will send oil prices down, and that will make inflation come down and trickle over to mortgage rates. So fingers crossed that happens soon. It was not good news to see that we were beginning strikes again. But hopefully, this gets resolved soon in a way that doesn't lead to more loss of lives and also leads to lower mortgage rates. Next thing, last week, going back to last week was jobs week, and last Friday we got the May BLS jobs report. So this is the big jobs report. This is generally the one the market's paying the most attention to, and this one showed a lot of strength. So as you can see, it came in at 172,000 jobs created. That was only supposed to be somewhere in the 80 to 100,000 range, so a lot stronger than expectations. The March and April numbers were revised higher. We've had a lot of negative revisions on that front. This time they were revised higher by 93,000 jobs combined. So again, added even more strength to this report. And then the unemployment rate stayed the same at 4.3%. So again, we don't want to see people lose their jobs. We want our economy to be doing well, but inflation being higher and the jobs market being stronger is basically the opposite of what we want to get the Fed to cut their rates, which would then lead to mortgage rates coming down because the Fed's not going to cut their rate if they can point to these job numbers and inflation numbers and show how high they are. We want the economy starts to show some weakness, and then the Fed cuts the rate to stimulate the economy. So next thing we got both CPI and PPI this week. So CPI is consumer side of inflation, and this came in hotter than expected. So it came in at the headline number was up 0.5% month over month. Core was actually a little bit lower than expectations, up at 0.2%. But again, rising gas and energy prices drove that hot headline reading. As you can see, looking at that graph, starting in February, which is the end of February is when the war started, you can see it's on an upward trend, which again, not good. The Fed is less willing to cut rates when inflation's higher. However, there's been some talk of the Fed raising rates at their upcoming meeting next week. And that really won't fix the issue because the Fed raising the rate won't make gas prices come down because that has no effect. That's not going to open the strait. That's not going to make oil prices come down and gas prices come down and so forth. So hopefully, that doesn't happen. However, these inflation numbers are concerning just because it's going to stand in the way of the Fed cutting rates anytime soon if they're concerned about inflation getting out of control. So CPI, again, came in higher than expected. PPI, same kind of thing, actually a lot higher than expected. It was supposed to be about 0.7%. It came out this morning at 1.1% month over month. So a big jump there. That's producer prices. And it was interesting though in those numbers, a lot of that gain had to do with portfolio management. So stock market's booming. Stocks are worth more. Portfolio management prices are going up because they usually get paid on commission based on how much they're making for you. So those numbers have kind of been going up quite a bit recently. So that has kind of bumped those producer inflation numbers up. However, again, any inflation, we don't want to see those numbers higher. The markets don't like it. The Fed doesn't like it, and we want the Fed to cut rates. Next thing, so we got May existing home sales this week, and it showed some resiliency in the housing market. So again, with all these negative things going on, these existing home sales in May. So that means a home that was closed in the month of May and was already built. It's not a new home, and it didn't go pending. It actually closed in the month of May, and that was up a 3.2% month over month, at 3.2% year over year. Some interesting numbers in there in the details. Their first time home buyers up to 35%, which that can be kind of volatile, that number, but it's I think the highest since 2020, which is good to see. Always like to see first time home buyers be able to get in the market and start building equity and things like that. And don't like to see it when there's too many cash buyers, because that tends to be investors and things like that. So like to see actual homeowners owning those homes. So again, some resiliency with some negative numbers, with rates a little higher. Still had a decent amount of activity across the country. So good to see there. Next thing we got. So where does that leave us? So last week we were at about 6.58. This week we're about 6.67 is the average conventional. Today's been pretty flat. Last couple of days have actually been pretty flat. A lot of that jump up came on that jobs report last Friday. So again, not where we want to be, but things are kind of hanging out. I think the markets and mortgage rates and everything is just kind of waiting for that war to be over because, like I've told some clients, as soon as we get some more concrete or even just some narrative about the peace deal coming to fruition, that tends to show a little rally. And again, anything concrete, any actual peace deal in place, that will probably cause a nice little rally in oil prices coming down, and in mortgage rates going down as well, because that will be connected to the inflation stuff. So 6.67, opposite direction. Start of the war, we were at 6. Important dates. So next Wednesday, the Fed meets and concludes our most recent meeting. Right now, the markets give it a 2% chance they cut rates, a 98% chance they do not cut rates. They keep them where it's at. That will be the new chair, Chairman Warsh, his first meeting that he'll be presiding over. So I personally, and I've seen this analysis a little, but I believe this will be an interesting one to watch the press conference afterwards. Like we've talked about, by the time Fed announcement comes, they've already made their decision. We already know what they're going to do. So there's really no movement on the technical side. A lot of it has to do with what they say afterwards, and what kind of details we get about what's going to happen in the future. And I have a feeling, since he's been on more of the dovish side and wanting to cut rates and wanting to see rates come down, and along with the president's, I would think that his tone will show that. So that might be something positive when he speaks next Wednesday, because again, the numbers aren't that great, but if he starts talking about they're confident about rates coming down in the future and all that, then the markets usually are going to react pretty positively. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.